I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.
Drain the swamp.
Hello, welcome to another installment of Liberty Nation's Swamponomics videocast. I'm Andrew Moran, Liberty Nation's economics editor. This week, what in the world is all this turmoil in the financial markets? It has been bedlam on Wall Street in recent days as trillions of dollars have been wiped out over a course of several sessions. The tech-heavy NASDAQ Composite Index is in correction territory. The blue-chip Dow Industrial Average is seemingly shedding hundreds of points a day. The broader S&P 500 is sinking. Suffice to say, it has truly been a bloodbath. So, what's going on exactly? Panic over tariffs, growing inflation expectations, increasing stagflation, or recession fears. President Donald Trump's on-again, off-again tariffs have caused a great deal of uncertainty among investors and businesses. While tariffs were virtually expected upon his November election victory, traders might have believed that he would include exemptions and exceptions and refrain from lifting tariffs to tremendous levels. Another thing that Wall Street probably did not bet on was the erratic pace and rhetoric surrounding tariffs. For example, President Trump threatened to increase steel and aluminum tariffs on Canada to 50% because Ontario Premier Doug Ford said he would cut off the electricity to the three states and slap a 25% surcharge. When the leader of Canada's most populous province backed down, Trump walked back his threat. But will it return? Still, the United States followed through on his 25% tariffs on all steel and aluminum imports. The next big plan will be the president's reciprocal tariffs on all U.S. trading partners in April. All of this is leading to concerns that Trump's tariff plans will rekindle the inflation flame. While economists have debated the merits of this consternation, investors think it is a real threat. Various economic observers have predicted increases to inflation ranging from a couple of basis points to as high as 1.4%. Treasury Secretary Scott Bessent recently said in an interview that there could be a one-time price adjustment, but he is not worried about inflation across the continuum. So far, inflation appears to be heading into a good place. The headline annual inflation rate slowed to 2.8% in February, and the March reading is starting to look good as well. The Producer Price Index, a measure of prices paid for goods and services by businesses and eventually passed on to consumers, was flat at 0% last month. The core component, which strips the volatile energy and food costs, actually fell 0.1%. Even eggflation fears are dissipating. While the Consumer Price Index showed a 10% monthly increase in egg prices, this was clearly a lagging indicator, as the U.S. Department of Agriculture has reported a 36% drop since eggs prices peak in early March. Will this curb the recent spike in inflation expectations? The various surveys, be it the University of Michigan's Consumer Sentiment Index or the Conference Board's Consumer Confidence Index, have spotlighted a spike in the inflation outlook. Whether the recent inflation data will calm consumers' fears waits to be seen. Finally, the R word, or in some cases, the S word. Investors freaked out when the Federal Reserve Bank of Atlanta's first quarter GDP Now model estimate indicated a near 3% contraction for the January to March quarter. The regional central bank projected an expansion for weeks before that tremendous revision. Other recession indicators have been flashing red, but once again, these fears could be overblown. The Atlanta Fed recently admitted that the contraction was a result of soaring gold imports, and when you remove this component, there's actually growth. So what about stagflation? These fears, which date back to the 1970s, have resurfaced on worries about anemic growth, elevated inflation, and rising unemployment. On the labor front, early data signal an intact labor market, whether the initial jobless claims or the February jobs report. On inflation, the CPI and the PPI and even the Trueflation report, which is a real-time metric of millions of indicators, are not exploding. On growth, the first or second quarters might make a dent if there's a drop in government spending, but as Liberty Nation News reported, this would merely be a paper recession rather than a real downturn in the private economy. Or, as Treasury Secretary Scott Bessent recently said in an interview with CNBC's Squawk Box, the U.S. economy would go through a detox period. Here's what he said.
We're trying to get rates down, and could we be seeing that this economy that we inherited starting to roll a bit, sure. And look, there's going to be a natural adjustment as we move away from public spending to private spending. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period.
The good news, however, is that the sell-off has forced traders to seek shelter into safe haven assets like U.S. Treasury securities. Yields have absolutely plummeted. The benchmark 10-year Treasury yield has tanked about 50 basis points since the recent peak in mid-January, which has helped provide relief in the mortgage market and the auto loan market. And remember, this has been achieved without the Federal Reserve cutting interest rates. Is the Trump administration trying to fuel a recession? Who knows? For now, the US stock market is in correction mode. This could be an opportunity for those sitting in cash and resting on the sidelines since the post-pandemic rally to dip their toes in the financial markets. That's it from this week. Please read my full Swamponomics column on the pages of LibertyNation.com, and be sure to check out my previous Swamponomics TV videos and interviews. Liberty Nation does not endorse candidates or campaigns or legislation, and this presentation is no endorsement. Thank you. I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.
Drain the swamp.